Inflation is the general increase in the prices of goods and services over time. It's a crucial economic concept that affects everyone's purchasing power, investments, and overall financial well-being. In this article, we'll discuss the causes and effects of inflation and explore strategies to protect your money against its erosive effects. Demand pull inflation. This type of inflation occurs when the demand for goods and services in an economy surpasses the supply. As demand increases, businesses raise their prices to maximize profits, leading to higher price levels. This can be driven by factors such as increased consumer spending, government spending, or foreign investment. Cost push inflation. This occurs when the cost of production for goods and services increases, causing businesses to pass on these costs to consumers in the form of higher prices. Factors that can contribute to cost push inflation include increases in wages, raw material prices, or taxes and regulations. Built-in inflation. This refers to the expectation of future inflation, which can become self-fulfilling. When businesses and workers expect prices to rise, they might push for higher wages or raise prices in anticipation, which then contributes to actual inflation. Monetary factors. Central banks and monetary authorities play a significant role in controlling inflation through the money supply. When a central bank increases the money supply, it can lead to an increase in spending and demand, potentially causing inflation. This is often referred to as monetary inflation. Exchange rate fluctuations. When a country's currency depreciates, the cost of imported goods rises. This can lead to higher prices for both consumers and producers who rely on imported goods, contributing to inflation. Now we will discuss the various effects of inflation in detail, covering both the positive and negative aspects. To give you a comprehensive understanding, we have divided the effects of inflation into four main categories. Redistribution of wealth and income. Inflation can lead to a redistribution of wealth and income among different groups in society. For instance, borrowers may benefit from inflation if they have fixed interest rate loans, as the real value of their debt decreases over time. Conversely, lenders and fixed income earners, such as pensioners and bondholders, may be adversely affected, as the purchasing power of their fixed income is eroded. Business investment and planning. Inflation can create uncertainty in the economy, making it difficult for businesses to plan and make long-term investments. This uncertainty can lead to reduced economic growth and job creation. However, moderate inflation can also act as a stimulus for businesses to invest in new projects and expand production, as they expect higher future revenues due to rising prices. Consumption and savings behavior. Inflation can impact consumption and savings behavior in different ways. When people expect prices to rise, they may increase their spending, which can boost economic activity. On the other hand, high inflation can reduce the purchasing power of savings, discouraging people from saving and causing a decline in the overall savings rate. This can lead to lower investments and slower economic growth. International trade and competitiveness. Inflation affects a country's competitiveness in international trade. If a country experiences higher inflation than its trading partners, its goods and services may become more expensive, resulting in a decrease in exports and an increase in imports. This can lead to a trade deficit, negatively impacting the country's balance of payments and potentially leading to currency depreciation. Measuring inflation is important for economic analysis, policy making, and understanding the cost of living. There are several methods used to measure inflation, with the most common being the Consumer Price Index and the Producer Price Index. Other methods include the GDP deflator. Below is a detailed explanation of each method. Consumer Price Index. The CPI is the most widely used method for measuring inflation. It is calculated by tracking the changes in prices for a basket of goods and services purchased by a typical consumer. The basket includes items such as food, housing, transportation, healthcare, and entertainment. The prices of these items are collected periodically, and the CPI is calculated by comparing the price of the basket in the current period to the price of the same basket in a base period. The percentage change in the index represents the inflation rate. There are two main types of CPI. A. CPI-U. This represents the spending habits of urban consumers and covers approximately 93% of the U.S. population. B. CPI-W. This index is more specific and covers around 29% of the U.S. population, focusing on wage earners and clerical workers. Producer Price Index. The PPI measures the average change in the selling prices that domestic producers receive for their output. It is calculated by tracking the prices of a basket of goods and services at various stages of production, such as raw materials, intermediate goods, and finished goods. By measuring the changes in input costs and output prices, the PPI helps to indicate inflationary pressures in the economy before they reach the consumer level. The GDP deflator, also known as the implicit price deflator, is a measure of inflation derived from comparing the nominal GDP to the real GDP. The GDP deflator is an economy-wide measure of inflation that covers all goods and services produced in an economy, including those consumed by the government and those invested by businesses. Protecting your money from inflation is essential to preserve your purchasing power and maintain the real value of your wealth. Here are several strategies to help you protect your money from the adverse effects of inflation. Invest in inflation-protected securities. Inflation-protected securities, such as Treasury inflation-protected securities in the U.S., are designed to provide returns that keep pace with inflation. The principal amount of these bonds adjusts according to changes in the Consumer Price Index, ensuring that the bond's value increases in line with inflation. Diversify your investment portfolio. Diversifying your investment portfolio can help protect your wealth from inflation. Allocate your assets across various investment classes, such as stocks, bonds, and real estate. A well-diversified portfolio can help mitigate the impact of inflation on your overall wealth. Invest in stocks. Equities or stocks have historically provided higher returns compared to other investment vehicles over the long term, outpacing inflation. Companies can often pass on increased costs to consumers, protecting their revenues and profits from inflation. Dividend-paying stocks can also provide a steady income stream that can help offset the impact of inflation. Invest in real estate. Real estate investments, such as rental properties and real estate investment trusts, can offer inflation protection. Property values and rental incomes typically rise with inflation, providing a hedge against the loss of purchasing power. Invest in commodities. Commodities, such as gold, silver, and agricultural products, can provide a hedge against inflation. The prices of these assets often rise during inflationary periods, preserving the real value of your investment. Gold, in particular, is often considered a safe haven asset during times of economic uncertainty and high inflation. Consider investing in foreign currencies. If your domestic currency is experiencing high inflation, you might consider investing in foreign currencies or assets denominated in foreign currencies. This strategy can help diversify your portfolio and protect your wealth from the devaluation of your domestic currency. Opt for inflation-adjusted annuities. If you are nearing retirement or already retired, consider purchasing an inflation-adjusted annuity. These annuities are designed to provide periodic payments that increase with inflation, preserving your purchasing power during retirement. Maintain an emergency fund. An emergency fund acts as a financial buffer during unforeseen events, such as job loss or medical emergencies. Inflation can erode the purchasing power of your emergency fund over time, so it's essential to periodically review and adjust the amount you have saved to ensure it meets your needs. Monitor your investments and adjust your strategy. Regularly review your investments to ensure they continue to meet your financial goals and risk tolerance. Be prepared to adjust your investment strategy as needed to protect your wealth from the effects of inflation. By implementing these strategies, you can help protect your money from inflation and preserve the purchasing power of your wealth over time. It's essential to consult with a financial advisor to develop a personalized plan that meets your specific needs and goals. And that's a wrap for today's episode. We hope you enjoyed this insightful journey through the world of economics here on Economic Pulse. If you found this information valuable, make sure to give this video a big thumbs up and subscribe to our channel for more updates and analysis.